Nick, welcome to the 2025 Financial Regulators Program here at Illinois State University. It's glad to have you back on campus again, one of our alums, and I really appreciate you taking the time to help educate the financial regulators. I guess one of the first questions as managing director at Aon, I was wondering if you could kind of just give us a high-level overview of what's going on in the global reinsurance space. What are kind of the trends?
Sure. So, global reinsurers have come across a period of a fairly substantial period of losses, kind of in the 2000 teens, kind of culminating in a fairly substantial loss of capital in 2022 with some of the interest rate fluctuations that happened, and really found religion. And I think as a market, insurers and reinsurers kind of came together to say that this relationship had to get fixed, because insurers need reinsurance capacity as well. It's necessary in their business plan. So there was a hard market that definitely went through for reinsurers, 2023 especially, continuing in 2024, and a reset of terms and conditions to bring reinsurers back to profitability. There was a fairly long period of elevated combined ratios, diminished investment returns, and eventually loss of capital. So that relationship's kind of been reset, and now we're kind of seeing a situation where, as we go into 2025 and go through 2025, reinsurers are coming off these hard positions with their clients. In the market in general, they're offering a little bit more rate decrease, a little more limit. They recognize that this is a very profitable market still, and they want as much market share as they can get. They have a lot of capital to deploy, so they're deploying it, and doing so with clients that they want to be long-term partners with.
Well, I noticed that as you were presenting, you talked about the changes in the alternative capital.
Sure.
that exists out there, and the trends related to things like cat bonds.
Yeah.
And surplus note sidecars.
Yeah.
So tell us a little bit about that. What is going on with respect to this alternative capital as a mechanism for reinsuring the
Sure.
market? Yeah.
So there's definitely a growing amount of capacity in the market that is alternative in nature, just being it's not the traditional reinsurance capacity you see where a client gives their 10-year experience and it's underwritten and priced, and this is more investor-based alternative capital that comes in, and it offers a diversification to our clients who may want just a different capital source in their reinsurance program. Comes in many different forms. In many different structures. The most common is the cat bond, as you referenced, where they're usually playing on top of property cat towers, and it's investor-backed money that's paid interest, and it's just a different form of return for the investors that go into the cat bond, and a different form of capital for our insurance clients to access to complete their program. And I'd say not all alternative capital is coming from outside investors. There are traditional markets that also have cat bond and alternative capital positions, and they have the same capabilities. So it's just new forms of capital and different forms of capital to do the job that we've previously done.
So it looks like the casualty market has been able to command some pretty strong rate, but there seems to still be this question about profitability with U.S. casualty going forward. So, what's going on with that?
Yeah, many years of adverse development or development beyond the insurer's initial and reinsurer's expectation in the 2010 onward, far beyond what they expected, and insurers and reinsurers learned some hard lessons, re-underwrote their portfolio, put a lot of premium rate through the portfolio, adjusted terms and conditions, reduced their capacity, and that dynamic really took foothold in 2019, continues to this day, because the outlook of most insurers and reinsurers is the U.S. tort environment has not improved. If anything, it's getting worse. There are still the advent of the increase in nuclear verdicts,
litigation funding,
yeah. social inflation running through loss costs. So I think, a lot of insurers and reinsurers are looking at the work they've done in the last 5 years. They are more confident in their portfolios, but they're still seeing this adverse loss development, even creeping up through the current years, actual exceeding expected. So the trend for a more firm casualty market continues. And from a reinsurance perspective, you've got a couple different camps. You've got some very large reinsurers that are very vocal that they've had enough of U.S. casualty and they want to, keep a limited market share. And then you've got others that they kind of see a more dynamic marketplace, one where rate is exceeding trend, and they're getting the terms and conditions they want. So they're kind of expanding in there quietly, because they have investors as well, and investors may not be too happy with U.S. casualty growth, but nonetheless, with the investment return that a lot of these insurers and reinsurers, if you consider the bad years, in 2010s, that was sitting on a float of 2%, with Treasury bonds. So now you're talking about excess of 4. It's a different dynamic, which plays into that math as well.
Well, one of the trends I have to ask you about is California wildfires.
Yeah.
How is what's happened in California, not just recently, but kind of overall the trend going to impact the reinsurance market?
Yeah, it's significant. When you look at the total scope of the property cat reinsurance market, and then you factor in the potential size of reinsurance loss for this one event or two events, it already puts reinsurers in a pretty significant loss situation, whatever that was, 7 days into the year. So a lot has to go right the rest of this year for cat reinsurers to get their full return on their portfolio. There's a wide range of estimates that came out, some as high as $50 billion. If that were to come to fruition, it is a massive market event, there's no question. But what we're seeing in the market, when we talk to reinsurers, there's still a large amount of supply. There are still some very well capitalized companies that have capital to deploy, and they want to deploy it. They see a market that firmed in 2023, remained very positive in 2024, is starting to slide a little bit, but still very profitable levels. So they want in on that, and they want market share, and they want their investors want their capacity deployed. So it's an event. It's a massive event. Probably affects West Coast and wildfire exposed areas more than does a company that's exposed to Midwest wind pay more money for their cat because of the wildfire? Not necessarily, but it stabilizes the market a little, but we still see more supply than demand.
Very good. So we are here, talking to the financial examiners and analysts about the different aspects of the industry and what's going on. With all these things that we've discussed, what would you say are some of the, maybe a big picture perspective on what would I look for, if I'm looking for the kind of financial implications
Sure.
For, insurers going forward here?
Sure. Regardless of the size of the company, reinsurance is a cost. It's it has to be paid for. I think those companies that are a little less capitalized and maybe smaller in nature, I'm thinking of like some mutual companies, Midwest mutual companies that are heavily reliant on reinsurance to maintain their capital. As that cost has gone up, it's strained them for sure. but it's a necessary purchase for them, and because of that, they're very cost aside. They work really closely with their reinsurers to maintain that relationship, so they understand the importance of it. Yeah.
Yeah, it makes sense. So if somebody wants to know more about this topic of what, and to, keep track of some of these trends and issues and challenges going on, where would they go to find more information about this?
Sure. So my firm, Aon, has a glut of market studies that we do across all lines of business, related to U.S. and global exposures, and not just the lines of business themselves, but market trends, studies, modeling. We did a large tariff study recently, so this is all available. This is and can be accessed through Aon.
Oh, that's great. Well, that'll be very valuable, for the participants and for those who weren't able to make it. And that's one of the reasons that we do the interviews, is for those who couldn't attend can find out a little bit more information about this topic. So thanks for taking the time, not only to present here at our 2025 Financial Regulators Program, but also to give an interview and kind of share some of your expertise with the rest of the world.
No, my pleasure, and it's great to be back
at
Katie School.
Great.
Thank you.